And so when we finish with Chapter 1, we should be able to explain why accounting is essential for decision making and managers in particular. We want to describe the major users and uses of this managerial accounting information, and we want to understand the role of budgets and performance reports in planning and control. We also want to be able to describe the cost, benefit, and behavioral issues involved in designing an accounting system, which accumulates, collects, and results in the reporting of the information. We want to discuss the role that accountants play in the company's value chain functions. We want to identify current trends in management accounting, and we want to explain why ethics and standards of ethical conduct are important to accountants. And obviously this idea of ethics and standards of ethical conduct are important whether we're talking managerial accounting, financial accounting, not accounting at all, but just business. And so we'll spend a little bit of time exploring that. And so one basic purpose of accounting information is to help make decisions. Every day, an organization has to face a new and continually challenging set of decisions. And many of these decisions rely on accounting information. When we understand how our decisions affect cost and revenues, we can become a better decision maker. The second basic purpose of accounting is to help plan and control the organization's operations. And this idea of planning and controlling is really what management is defined as, right? So plans describe how the organization will achieve its objectives. Control is the process of implementing plans and evaluating whether the organization is achieving its objectives. And again, when we understand how people respond to the incentives created by performance evaluation and control systems, we'll be better able to assess which system creates the most appropriate incentives. So management accounting is the branch of accounting that produces information for managers within the organization. It is the process of identifying, measuring, accumulating, analyzing, preparing, interpreting, and communicating information that helps managers fulfill organizational objectives. Financial accounting is the branch of accounting that develops information for external decision makers, such as stockholders, suppliers, banks, and government regulatory agencies. And so we can see here that we really have these two branches of accounting. One being management accounting, which we're going to cover in this group, and that really has an internal focus, and the other being financial accounting, which you've covered or will cover in other classes related to financial accounting, that really has or is geared toward external users. The Certified Management Accountant, or CMA designation, is the internal accountant's counterpart to the CPA, or Certified Professional Accountant. The Institute of Management Accountants, or IMA, is the largest U.S. professional organization focused on internal accounting, and it oversees the CMA program. CMAs must pass an examination covering financial planning, performance and control, and financial decision making. Like the CPA designation, the CMA confers higher status and leads to more responsible positions and higher pay. And so an accounting system is a formal mechanism for gathering, organizing, and communicating information about an organization's activities. In order to reduce cost and complexity, many organizations use a general purpose accounting system that attempts to meet the needs of both external and internal users. However, as outlined in Exhibit 1-1, there are important differences between management accounting information and financial accounting information. And so there are courses that are focused more on the design and development, and implementation of an accounting information systems, and I encourage you, if you're at all interested in these, to consider taking one, because they can be very useful and helpful in your career, particularly since the tools that accountants use are changing so often. So what kinds of information do managers need to achieve their goals and objectives? Good accounting information helps answer three types of questions. That is, scorecard questions, or scorekeeping, and such as, is the company doing well or poorly? Scorekeeping is the classification, accumulation, and reporting of data that helps users understand and evaluate organizational performance. Scorekeeping information must be accurate and reliable to be useful. For example, Starbucks produces numerous reports to evaluate results for stores and divisions. Attention-directing questions would be something like, which areas require additional investigation? So, is a product line profitable? Am I generating the level of profit anticipated? What about my capital budgeting decisions? Which capital budgeting alternative do I want to take advantage of? Attention directing usually involves routine reports that compare actual results to before-the-fact expectations. For example, a manager who sees that Starbucks store has reported profits of $120,000 when budgeted profit was $150,000 will look for explanations as to why the store did not achieve its budget. Attention directing information helps managers focus on operating problems, imperfections, inefficiencies, and opportunities. And then finally, we have problem-solving questions. So, of the alternatives being considered, which is the best? The problem-solving aspect of accounting often involves an analysis of impact of each alternative to identify the best course to follow. For example, Starbucks experiments with adding various items to its menu. After an analysis of how a new product will affect revenues and costs, management decides which items to add and which to delete. And so again, we can see that there are each of these questions, right? Scorekeeping, attention directing, or problem solving has unique information needs in order to provide the best possible alternatives available. And they're all internally focused questions, and the role of management accounting is to provide that accounting information in order to help improve the decision making as much as possible. So accounting information helps managers plan and control the organization's operations. In practice, planning and control are so intertwined that it seems artificial to separate them. In studying management, however, we find it useful to concentrate on either the planning phase or the control phase to simplify our analysis. The planning phase, which we see, refers to setting objectives for an organization and outlining how it will attain them. Thus, planning provides the answers to two questions. What objectives does the organization want to achieve? When and how will the organization achieve these objectives? Control, on the other hand, refers to implementing plans and using feedback to evaluate the attainment of objectives. Feedback is crucial to the cycle of planning and control. Planning determines actions, actions generate feedback, and the control phase uses this feedback to influence further planning and actions. And so what we see here then is an accounting framework for planning and control. A budget is a quantitative expression of a plan of action. Budgets also help to coordinate and implement plans. They are the chief devices for disciplining management planning. Without budgets, planning may not get the front and center focus that it deserves. The Starbucks store expresses its plan for product and growth and improved marketing through revenue and advertising budgets. Performance reports then provide feedback by comparing results with plans and by highlighting variances, which essentially represent deviations from plans. Organizations use performance reports to judge managers' decisions and the productivity of organizational units. So let's walk through an example of this. The Mayfair store report shows that the store met its targeted sales. We see that where we have the first line there, sales budget versus sales actual with a zero variance. But the $2,500 unfavorable variance for ingredients shows that these costs were $2,500 over budget. We were budgeted at a $50,000 sales volume to spend $22,000 on ingredients. We see that line versus the actual, we spent $24,500, so we have a $2,500 unfavorable variance. Other variants show that store labor costs were $400 under budget, and other labor was $50 over budget. At the Mayfair store, management will undoubtedly focus attention on ingredients, which had by far the largest unfavorable variance. And so we can see that this is just a very simple example of how we're, as management accountants, we're providing information so that managers can look at issues like budget versus actual performance so that they can then identify the problems, focus on the alternatives to correct the problems. There are three categories of requirements imposed on accounting systems designed to meet the requirements of external users. First, companies' financial reports for external users must adhere to the set of standards known as generally accepted accounting principles. The Financial Accounting Standards Board determines United States or U.S. GAAP, generally accepted accounting principles. In the European Union and more than 100 countries worldwide, companies must comply with International Financial Reporting Standards, or IFARS, set by the International Accounting Standards Board. Second, every company is also subject to various taxes and therefore subject to various reporting requirements specified by tax rules and regulations. And then finally, many companies are subject to other government regulations. There are many other government regulations that influence accounting systems. For example, the Sarbanes-Oxley Act, passed in 2002, added several levels of regulation. Driven by corporate bankruptcies blamed in part on accounting lapses such as deficiencies in corporate governance, lax securities regulations, and executive greed, this act requires more top management oversight of a company's accounting policies and procedures. By requiring chief executive officers to sign a statement certifying the accuracy of the company's financial statement, the act makes accounting numbers the concern of all managers, not just the accountants. Sarbanes-Oxley requires external auditors to examine and prepare a separate report on the company's system of internal controls, which are policies to protect and make the most efficient use of an organization's assets. While some managers insist that the extra cost of compliance with Sarbanes-Oxley will exceed the benefits, others believe that the regulations provide stronger controls and more informative reports whose benefits exceed the cost. Another example of broad regulation is the Foreign Corrupt Practices Act, a U.S. law forbidding bribery and other corrupt practices. The word foreign in the title is misleading because the Act's provisions apply to all publicly held companies, even if they don't conduct business outside the United States. This law requires that companies maintain their accounting records in reasonable detail and accuracy. Internal auditors review and evaluate accounting systems, including companies' internal controls, and conduct management audits, which are reviews to determine whether managers are implementing the policies and procedures specified by top management. A final specific area of regulation is government contracting. Universities, defense contractors, and others contracting with the U.S. government must comply with numerous reporting requirements. And so we can see that in just these few items we talked about, there are significant influences on accounting systems, not to mention internal management's influence on the accounting system and its ability to develop and report on the information that they need. And so this slide just talks a little bit more about the Sarbanes-Oxley Act, which was really as a consequence of the scandals involving Enron and MCI and WorldCom, where the external the internal management, senior management of the company, just engaged in fraudulent activities to mislead investors, which caused a great many people to lose money, not only external investors, but employees of the company who have stock, pension plans that held stock in the company. There's a long list of articles that you could read as far as background on this. It was also, this whole episode with respect to MCI is widely regarded as the initial demise of Arthur Andersen, who were their public accountants, and who ultimately went out of business as a result of this. So in response to this, Sarbanes-Oxley Act was created by Congress, which is geared toward making that senior management more responsible for the reporting of financial results. So the cost-benefit balance, which is really what we're talking about here, what that means is we're weighting estimated costs against probable benefits, and it's the primary consideration in choosing among accounting systems and methods. We refer again and again to cost-benefit considerations throughout our sessions. Accounting systems are economic goods, just like office supplies or labors, available at various costs. Managers should also consider behavioral implications, that is, the system's effect on the behavior, specifically the decisions of managers. In a nutshell, think of management accounting as a balance between cost and benefits of accounting information coupled with an awareness of the importance of behavioral effects. Therefore, management accountants must understand related disciplines such as economics, decision sciences, and behavioral sciences to make intelligent decisions about the best information to supply managers. Product life cycle refers to the various stages through which a product passes: conception and product development, introduction to the market, maturation of the market, and finally, withdrawal from the market. At each stage, managers face differing cost and potential returns. And as you can imagine, at each stage, there are different organizational considerations that have to be taken into account. So in addition to considering a product's life cycle, managers must recognize those activities necessary for a company to create the goods or services that it sells. These activities comprise the value chain, that is, the set of business functions or activities that add value to the products or services of an organization. These functions include research and development, or the generation of ideas related to new products, services, or processes, the design of products, services, or processes, which involves the detailed design and engineering of what we're offering to sell, whether that's a product or a service or a process, and then the production of that, that's the coordination and assembly of resources to produce a product or deliver a service. Then we also have to consider the marketing, which is the manner by which individuals or groups learn about the value and features of products or services, the distribution, which is the mechanism by which a company delivers products or services to the customer, and then customer service. Those are the support activities provided to the customer. Accountants play a role in supporting all the value chain functions. And accountants are, in fact, a part of this value chain in that their actions and support should also add value to this entire process. So the role of management accountants in organizations has changed rapidly over the last decade or so. Consider the following 4 work activities of management accountant: collecting and compiling information, preparing standardized reports, interpreting and analyzing information, and being involved in decision making. Over time, the role of accountants as it regards any one of these 4 activities has tended to grow to where, again, accountants are increasingly involved in the day-to-day operations and management decision-making of the organization. And they're often looked to as primary sources of input as far as getting to better decisions or the consequences or projected consequences of current decisions. So as an organization grows, it must divide responsibilities among a number of managers and executives, each with specific responsibilities. Line managers are directly involved with making and selling the organization's products or services. Their decisions lead directly to meeting or not meeting the organization's objectives. In contrast, staff managers are advisory. They support the line managers. They have no authority over line managers, but they help the line managers by providing information and advice. This organizational chart shows how a traditional manufacturing company divides responsibilities between line and staff managers. The line managers in manufacturing are supported by sales, engineering, personnel, and financial staff support at the corporate level, and by receiving and storeroom inspection, tool room purchasing, production control, and maintenance staff at the factory level. The Chief Financial Officer, or CFO, is a top executive who deals with all finance and accounting issues. They oversee the accounting function in most organizations. Both the Treasurer and Controller generally report to the CFO, as shown in our chart here. The Treasurer is concerned mainly with the company's financial matters, such as raising and managing cash, while the Controller is concerned with operating matters such as aiding management decision making. In a small company, one person may perform both treasury and controllership functions, and in fact may also be the chief financial officer. But nevertheless, it's useful to differentiate between the two different roles because, again, as a company grows and as they become larger and larger, these functional areas become more specialized, and then with that specialization, we see the need to break these out from one another. And so it's good to understand, well, what is the difference between a controller and what is the difference with respect to responsibilities of the treasurer. So 4 major business trends are influencing management accounting today. One is the shift from a manufacturing-based to a service-based economy in the United States. That is to say, we make less and less hard, tangible stuff in the United States. We see an increase in global competition. We see advances in technology, and we see changes in business processes and in business process management. So think a few minutes about how some of those changes might be causing an organization to adapt and change itself. Because we do see this in business, that it is just a constant state of change, and not just a constant state of change, but an increased pace in that change in order to respond to some of these specific items. Manufacturing organizations develop many of the basic ideas of management accounting. These ideas, however, have evolved so that they apply to all types of organizations, including service and nonprofit organizations. Service organizations, for our purposes, are organizations that do not make or sell tangible goods, but instead provide other forms of value. Public accounting firms, law firms, management consultants, real estate firms, transportation companies, banks, insurance companies, and hotels are examples of profit-seeking service organizations. Most nonprofit organizations, such as hospitals, schools, libraries, museums, and government agencies, are also service organizations. Then we talk about the common characteristics of service organizations, and they include labor, which is a major component of cost. The highest proportions of expenses in service organizations, such as the schools and law firms we talked about, are typically wages and salaries and payroll-related costs, not the costs related to the use of equipment and physical facilities. Output is usually difficult to measure. Because service outputs are intangible, they are often hard to measure. For example, the output of a university might be defined as the number of degrees granted, but many contend that the real output is the knowledge and beliefs the students develop during their time at the university. Service organizations also cannot store their major inputs and outputs. There's not much there when you think about inventory, like we have when we talk about a manufacturing or production company. Services cannot usually be stockpiled. For example, an airline cannot save empty airline seats for later flights, and a hotel's available labor force and rooms are either used or unused as each day passes. So we can see these kind of common organizations, these common characteristics related to service organizations. A major effect of technology on accounting systems has been the growing use of enterprise resource planning, or ERP systems, integrated information systems that support all functional areas of a company. Accounting is just one part of such a system. One of the most rapidly growing uses of technology is electronic commerce, or e-commerce, that is conducting business online. I'm sure we've all bought something from Amazon or bought something from some online vendor. While the internet boom that focused on business to consumer, or B2C, transactions ended in 2001, e-commerce focusing on business to business transactions continued to grow at nearly 50% a year. Business to business creates real savings to the companies involved. One management change leading to increased efficiency in business processes has been the adoption of a just-in-time philosophy. Another management approach focused on efficiency is lean manufacturing, which applies continuous process improvements to eliminate waste from the entire enterprise. A focus on quality is also important in today's competitive environment. A decade or so ago, many companies undertook TQM, or Total Quality Management initiatives. These initiatives are targeted at minimizing costs by maximizing quality. It focuses on continuous improvement in quality and satisfying one's customers. Recently, the focus on quality has shifted to Six Sigma, which is a disciplined, data-driven approach to eliminating defects in any process. So again, we can see this is just a constantly evolving and moving and changing area that we're operating in. And it's exciting frankly, to be a part of it. And as students and as people who are facing their careers and entering into their careers, there's a lot of opportunity to become involved in some very new, interesting, and initially developing initiatives. So the Institute of Management Accountants Statement of Ethical Professional Practice for Management Accounting members requires members to adhere to a code of conduct regarding competence, confidentiality, integrity, and credibility. Business processes and accounting systems change. However, the need for accountants to maintain high ethical standards of professional conduct will never change. The Institute of Management Accountants says that ethics deals with human conduct in relation to what is morally good and bad, right and wrong. It is the application of values to decision making. These values include such things as honesty, fairness, responsibility, respect, and compassion. And so I can't stress enough to students coming out of school today, or students as they start their focus and discipline of study, that ethics and your reputation for being ethical and for being honest and for being fair is invaluable. And frankly, it's not something you can buy. If you're labeled, and it's a small world, and you're labeled in industry, or you get a reputation as being unethical, you may still be appealing to many organizations as employees, but those organizations, frankly, if that's what their management is looking for, are unethical employees, then that organization is short-lived, and then the long-term consequences of that can be quite devastating. So please, please, please always practice ethical business. Enough preaching from me. So the Institute of Management Statement of Ethical Professional Practice for Management Accounting members is what is presented here. And so I encourage you to take some time, either now or as we proceed to the course, and come back to this and read it and kind of take it to heart and understand what it means for you in the day-to-day way that you conduct your scholastic efforts, and the way that you conduct your dealings with others, and how you conduct yourself in business if you're in that situation at this point. And this goes on, it's a continuation of the previous slide, but it goes on to talk about, well, how do we resolve ethical conflicts? Because for sure, ethics is not black and white, it's a gray area. Conflict is going to arise. We need to have some model or way of thinking about how we resolve it, and some guidelines, and what to think about as being important as we work toward resolving it. And that's what this slide is intended to provide us. And so no regulation can be as effective in ensuring reliability as high ethical standards of accountants are. Managers must choose an alternative, and then there are significant value conflicts among differing interests. There are real alternatives that are all justifiable, and there are significant consequences to stakeholders in the situation. So accountants must draw the line someplace, and it is usually better to err on the side of full disclosure than to withhold important information. To maintain high ethical standards, accountants and others need to recognize situations that create pressures for unethical behaviors. 4 such temptations summarized in the Financial Executive are as follows. Emphasis on short-term results. This may have been the largest issue in the recent spate of ethical breakdowns. If making the numbers is goal number 1, accountants may do whatever is necessary to produce expected profit numbers. Secondly, ignoring the small stuff. Most ethical compromises start out small. The first step may seem insignificant, but large misdeeds are often the result of many small steps. Toleration of even small lapses can lead to large problems. Thirdly, economic cycles. A down market can reveal what an up market conceals. While Enron was flying high at the turn of the century, no one seemed to question its financial reports. When the economy took a downward turn, managers made ethical compromises to keep pace with expectations of an up market. The result was a huge crisis when scrutiny revealed many questionable practices. Similarly, later in the decade, companies such as AIG, Fannie Mae, and Freddie Mac were accused of accounting compromises after the economy started to sour in 2008. Companies need to be especially vigilant to prevent ethical lapses in good times when such lapses are more easily concealed, and thereby avoid revelation of lapses in bad times when their effects are especially damaging. And then finally, accounting rules. Accounting rules have become more complex and less intuitive, and making abuse of the rules harder to identify. Ethical accountants do not just meet the letter of the law, they seek full and fair disclosure, conveying to users the real economic performance and financial position of the company. And so this concludes Chapter 1. I encourage you to go back and read the chapter again if necessary, and then proceed on to the discussion forums and the associated learning exercises. And I look forward to talking to you in Chapter 2.